Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined with two of my wonderful colleagues, Cris DeRides, he's deputy chief economist, and Marisa DiNatale. Marisa, what's your title? I don't even know what that is. I think I ask this every time you're on the podcast.
Senior director.
Okay, there it is.
Yeah, it's pretty simple.
Well,
she does a lot of things.
Pretty unexciting.
Exactly.
hard to summarize.
She keeps the train on the tracks, as far as I'm concerned. Yeah. So all the forecast work that happens all around the world, Marisa manages that process, and that's a very difficult process. So, very important to have her on our team. So good to have you, Marisa. I know it's early.
Thank you. Thanks for being here. Yeah.
Southern California.
It's okay.
Yeah,
I'm used to it at this point.
Yeah, 5 a.m.
4:30 a.m. wake ups.
I deserve a little sympathy.
It's late.
It's 9. What time is it? 9:08 Tokyo time. PM.
Okay.
I showed you Singapore last Friday, I believe. There's Tokyo behind me.
Lovely.
Oh, nice.
I'll have to say, a strong dollar is a beautiful thing.
Yeah.
It opens up many opportunities.
Okay, we just lost 80% of our listeners. Okay.
You should go to London next.
No, I was there before. That was my first stop.
Okay, you should go back.
Cheap.
Yeah.
Cheap. Yeah.
Great time to visit Europe.
Yep.
What's that, Cris?
Great time to visit Europe.
Oh yeah, great time to visit anywhere. In Tokyo, it's 147 to the dollar, right? I mean, that's incredible. That's I think you got to go back 25, 30 years to find a yen that weak against the dollar. That's all people are talking about here, by the way, is the weak yen. So and whether the Federal Reserve should be more sensitive to the rest of the world when setting monetary policy.
I've gotten that question a lot.
Yeah, right. Okay, well, we've got a lot to talk about. This is the Friday, October 14th. Is it? Or it is still October 14th, right? I'm confused a little bit.
Yes.
It's still October 14th. Okay,
it just started for us.
I'm so confused by these time zones. And we need to talk about the consumer price report that came out yesterday. A lot going on there. While we're in this conversation, the retail sales numbers for the month of September are going to come out. And maybe one of us can take a look at that and give us a sense of those numbers, because that's kind of critical to what's going on the growth side of the economy. And we'll play the stats game. I think we'll have a little bit of fun with that, and we'll call it a podcast. I was going to say one other thing. I can't remember what it was. It'll come back to me. But anyway, this is what it was. So I'm having a conversation with a client here in Tokyo, and they're saying, "Boy, inflation is so high. It's really high." And I'm going, "Oh, what is it?" And of course, I knew what it was, but just to further the conversation, he goes, 3%. Inflation is 3%. I go.
It's high by Japanese standards.
Yeah, I go, buddy.
You want to trade?
You want to trade? I should have said that. Yeah, right. So that leads into the CPI number, the Consumer Price Inflation Report. And I don't know, Cris, do you want to summarize that? Can you summarize?
Sure.
What you're saying? Yeah.
Yeah, I'll summarize it in a word: hot. Very hot. The headline CPI, so overall consumer price index, came in at 8.2%, right? Year over year. Month over month, that's 0.4%, which was very high. Our expectations were for 0.2%, so double what we expected. And that's up from August, which was 0.1%. So moving in the wrong direction, certainly. Shelter, food, medical care were primary reasons. But one thing that struck me about the report is just how broad the price growth is. Energy came down a bit, but because of gasoline prices, but food was up 0.8% again, and that certainly hits consumers' pocketbooks directly. Core inflation was up as well, right? So this is equally disturbing, perhaps even more disturbing. This should be the one that the Fed is focused on a bit more, stripping out food and energy. Up 0.6% in September, same as August, and we are at 6.6% year over year. So here again, we expected it to rise a bit, 0.3, but it came in much faster than that expectation. And again, kind of a broad-based set of factors impacting the core as well. You had shelter, so house prices housing costs rather, still impacting and pushing up core inflation. What was it? New vehicle prices came in a bit stronger. Motor vehicle insurance, medical care. So lots of factors lots of components that were driving inflation up.
Yeah, and as you point out, well above our expectations, both on the top line and on core, I think as well, right? We were expecting.
Yeah. We're expecting 0.3% growth in core, so did expect to see a continued rise there, but 0.6 is really high. That's double.
Yeah. Okay. Bummer. I'll have to say, very disconcerting. That's 2 months in a row, pretty disconcerting CPI reports, at least at face value. Marisa, anything to add there? Anything you want to fill in?
Just that within all these components, it's really the service sector that was hotter. So core goods on a month-to-month basis was zero. Prices stayed the same. So it was really services that picked up, and the growth in services was faster than it's been in months and months and months. And as Cris said, it's housing, it's medical care, it's airfare, airline tickets, transportation, kind of across the board.
Well, there goes my statistic.
Oh.
Good job.
You always have to have a backup. All right.
I do have a backup. I absolutely have a backup, but the services definitely was something to emphasize. I'm with you.
You know what struck me? How many components of the report had an increase of 0.8%.
Yeah.
Not like it was everywhere.
Yeah.
You know, food prices were up 0.8%.
You're right.
Rent of shelter up 0.8%. Homeowners equivalent rent, which is what the theoretical rent homeowners pay, up 0.8%. Airfare up 0.8%. It was like, come on. It was 0.8 everywhere. And of course, that's month to month.
Yeah.
And to annualize it, simply multiply by 12, and you go, "Oh,
that's shocking." Yeah,
that's pretty close to 10% annualized growth. So that got me, pretty disconcerted. Very, very hot inflation number. I'm going to do two things though. One is I want to talk about the outlook for the CPI inflation, and I'm going to put a frame around that, and I want to go component by component and talk about where it feels like inflation for those components are going, and then add it up to total inflation. And then when I do that, I feel a little more comfortable about the outlook. I mean, obviously, the here and now, there's nothing to feel comfortable about, but the outlook feels better to me. But before I go there, the other thing I want to do is, what in the world is the markets thinking? So, okay, so the CPI number, here, I'm in Tokyo. Of course, the CPI number comes out late in the evening, and I look at the number, and of course, I see nothing but red everywhere. Stock prices are down a lot. I think the S&P 500, is it down to 3,500? Is that?
It touched 3,500, yeah.
3,500. And for context, the peak back in the start of the year was 4,800, right? So that, we were getting down into down 25% plus, something like that. And I think the Dow, what was the Dow down at the low point, yesterday? Was it down 5, 6, 7, 800 points? I don't know. A lot of red. Bond yields are going skyward. I saw the 10-year Treasury yield at 4%. The dollar soaring. That's what you would expect. So you get this hot inflation number that says the Fed's got to go on high alert. That may mean higher interest rates than is currently discounted, that was currently discounted in the market. Then I go to bed. By the way, I couldn't go to sleep right away. It jacked me up, the damn number, which never happens. Maybe it conflated with jet lag. I'm like flying all over the world. So could be that, I'm not sure. And then I wake up and I see nothing but green. And I'm like, I go, oh, this, maybe my screen didn't refresh from 5 days ago or something, you know, like, or maybe I'm looking at the Nikkei or something, you know, or maybe I'm looking at P prices. I was like so confused, and it was up 800 points. The S&P, what did the S&P end at? 3,700, something like that. So, okay, Chris, what explains what in the world? And it's not just the equity market. It's felt like all markets kind of changed, pivoted, you know, sometime when I went to bed and when I got up in the morning. So in Tokyo time. So what happened? And as you know, I sent. Here's a funny thing, Marissa. So I'm emailing with Chris and Ryan, and I'm saying, what happened to the stock market? And I had to ask that question, I'd say 5 times before I got any kind of answer whatsoever. These guys were just ignoring me. They were ignoring me. And then finally, I was thinking, maybe I should put it in all caps. You know, what happened to the stock market? So what happened?
5 times? I don't know.
I don't know. Okay,
I was waiting for Ryan to give his answer.
3 times.
You know, it's hard to say from a fundamentals, right? Everything you described in the first part completely made sense, right? Number comes in, the inflation number comes in hotter than expected. The market craters, right? You would expect that all made sense. Why did it rebound all of a sudden? It's speculation, right? A lot of animal spirits there is what I would suggest. You could say, well, maybe the investors digested the report, the CPI report, and yeah, it was hotter, but they kind of expected it would be hot for a while. So they start read through the report and realize that it's not terribly different from the Fed script. Fed's still going to go 75 basis points this month. May not change the trajectory all that much, and maybe they turned it around. But that's hard to justify in terms of the massive rally that came back, right? That would justify, okay, maybe they take back some of the losses, but why continue or propel the market up? My explanation might be just some type of triggered trading, right? It's curious to me that the bottom was right at 3,500. We know that there's a lot of cash sitting on the sidelines, especially with higher income households. I suspect that they may have triggers out there that says if the market hits 3,500, that's the time to invest. So maybe that explains part of it, or algorithmic trading, kind of doing the same thing and taking on a mind of its own. We know that much of the stock market trading today is actually algorithmic, done by robots rather than people. And as soon as those prices start to rise, there's momentum trading that goes on, and it can propel things higher. So bottom line is, I don't know. There's no economic reason I can see for this type of reaction here.
Was it broad based or across all sectors, or was it? Yeah.
It was fairly broad based. The banks and the sectors that would do, I guess, relatively better in inflation or with higher rates did rally, but it wasn't exclusive to those sectors. It was fairly broad based. So.
Well, maybe
we'll see. It could just be a classic bear market rally, right?
Yeah,
these things happen too. So.
Well, I will have to say, last night before I went to bed and I saw all the red on the screen, I was thinking to myself, I think I'm going to buy, because
there you go.
I'm a long-term investor. I don't care if it goes down another 5 or 10%. This is now value. We're now at a place where the stock market is, the PE multiples are way in, and ultimately you can't bet against American companies that are going to do well. So if you want an entry point into the equity market, this is your entry point. Maybe it goes lower, I don't know, but I'm not worried about that because I'm looking long run. And you can buy a lot of stocks that seem so out of reach, not long ago, and now feel very good. And so, that people have got cash, right, that they built up. I think you mentioned this, during the pandemic. sitting in their checking accounts and they're saying, what do I do with this cash? I get that question all the time. What do I do with this cash? From my mother-in-law on down, what do I do with this cash? And well, my mother-in-law is 93, so I wouldn't say, Mom, buy equity at this point, but nonetheless, you get my point. And then maybe, then you get short covering, right? Maybe you have folks out there that shorted the market and they are getting caught and need to cover their shorts, and that drives the market up a little bit further as well. And then the algorithmic trading kind of kicks in, and so maybe it's mostly what you call a technical, but maybe there's some fundamental element to it. You got this floor under price because people have a lot of, particularly high income households that tend to invest in stocks, have a lot of cash sitting there earning nothing, so they might feel this like this is an opportunity. I don't know. But the other thing is it wasn't just the equity market, it was the bond market. So, 10-year yield, I think it's kind of ended where it started, 3.95, 3.9, got to 4%, maybe a little bit above, came back, 3.95, didn't feel like it, moved to any significant degree based on the report. The currency market, the crypto market, everything felt like it kind of did a full U-turn and landed where it was prior to the report. So I found that, very perplexing, very interesting. Okay.
10 years at 388 now.
Is it at 388?
Yeah.
So even oil prices, take oil prices, right?
Yeah.
Oil prices are back down. So OPEC announces a 2 million barrel a day cut, which the reality is, it's probably closer to 1 million, given that a lot of OPEC members weren't producing their quota. And prices did jump for a day, maybe two, and they're not that far. They're within spitting distance of where they were before there was the rumors around the OPEC plus cuts, came into being. So, it's really quite interesting, that the markets didn't react to it. Certainly not in the way I would have anticipated. Let's talk about the outlook for inflation and continue to focus on CPI inflation. Then we can broaden out to the PCE, the consumer expenditure inflator, which is the price measure the Fed tends to look at. And here, I just want to try something out on you. My forecast is that on a year-over-year basis, CPI inflation, which, as you said, is 8.2, is cut roughly in half 6 months, 9 months from now. And then as you look out, say, 18 months from now, 12, 18 months from now, it's back down to target. So you go from 8%-ish down to 4%-ish pretty quickly here in the next 6 or so months, kind of hang there for a little bit, and then it slowly starts to come into around 2.5%, which is kind of the top end of the range for the consumer price index, for the target range for the Fed by early 2024. Let's say the spring, early summer of 2024. And the way I get there is I kind of go through each of the components of inflation and say, where is this headed on a year-over-year basis? So let's do that one at a time. Number one, energy prices. So here I'm assuming that oil prices stay roughly where they are. 90 on WTI, it's below 90, but Brent is a little bit above 90. So let's just say they stay around 90, 95 bucks, maybe get as high as 100 bucks a barrel, going forward. If that's the case, then gasoline prices will stabilize around $4 a gallon. Remember, the peak was $5 a gallon back in the summer, June. They got as low as, I think, $3.50, $3.60. They're now back. They're going to hang around $4. If we stay there on a year-over-year basis, inflation, energy price inflation will, abate. Right now, it's still very positive on the year-over-year basis because at $4, you're still well above where you were a year ago. But that'll come out by March, April next year and basically, go away as a source of inflation. Okay, let me stop there. What do you think of that outlook for energy prices and its contribution to inflation? Marisa, do you have a view on that?
I think that makes sense. I would expect not much change going forward in energy prices, right, on a month-to-month basis. So then it's, what about all the downstream stuff to energy that is inflationary too? Other energy-related commodities, other things that use energy as inputs. Should we expect to see a downshift in price growth in those categories too?
Right.
I know you'll get to this, but I'm just sort of teeing it up. Some of the components, like let's say transportation or food, we know food is very closely linked to diesel prices. So some of that we're starting to see, you can see bits of it starting to come in, but other parts of it are still very inflationary and have been picking up. So it's a little more, I think those components are harder to get, at least for me, they're harder to gauge. It's a little more nuanced when you go line by line through some of the other things related to energy. But overall top line energy, I agree with that.
Yeah, and you make a good point about, because the food prices have been rising very rapidly.
Right.
A lot of that is the cost of transporting the food from the farm to the store shelf. That goes to diesel. Diesel prices have been more elevated than gasoline prices because a lot of that diesel is finding its way into Europe, where prices are higher because of the problems created by the Russian invasion of Ukraine. But nonetheless, you would expect that would, with lower oil, lower diesel prices, that would take some of the steam out of food price inflation going forward. The other thing is, on the with regard to food prices, is the agricultural commodity prices. They have come back in. They surged. Many of them surged.
Right.
During the Russian invasion, at the start of the Russian invasion, everything from wheat, corn to fertilizer. But that has come back in, so that also should take some pressure off of food prices. Cris, what do you think of that outlook for oil and the implications for inflation?
I think it's reasonable that we would kind of fall in this target range. That seems to be what OPEC Plus is also designing. I think you have to answer this question. Really need to think about the recession question, right? I'm going to bring it up early here, but it really depends if you think we are going into recession, or if we actually do go into recession globally. Then certainly you could actually see energy dragging or taking away from inflation, right? It could actually turn negative. But
well, can I stipulate on my forecast from 8 to 4 in 6-9 months to 2.5, 12, 18 months, or more closer to 18? That is a non-recession scenario. So
that's what I figured. Yeah. Wild card, I would want to get your opinion on is the Strategic Petroleum Reserve, which has been helping keep prices from going even higher, right? Releases from the SPR. That's set to, well, there's no plan I know of to increase those certainly, and actually is set to be refilled at some point. Does that act as a drag and actually support price growth, or would OPEC compensate? Is this just are the recent actions by OPEC Plus just compensating for the Strategic Petroleum Reserve? So, it'll net out if we back off on, or if the U.S. backs off on the SPR releases, then OPEC will back off on its hikes, or what do you think is the dynamic there?
Yeah, so two things. One, I do expect more SPR releases, and I'm assuming we get on average a release of about 700,000 barrels a day over the course of the next 6-9 months, and that is critical to providing the supplies necessary to fill the void left by the sanctions on Russian oil. And I am assuming the European Union does follow through on its sanctions, and that's 4.4 million barrels a day that comes offline as we move into next year when they implement the sanctions. So I am assuming that, and I do think there's enough oil in the SPR to kind of provide that to the marketplace through most of next year. Then it might get a little hairy as you start to draw down the SPR inventories. But the second thing is, I agree. I concur with what you alluded to, and that is, I think the Saudis and OPEC are calibrating production quotas to maintain an oil price that's somewhere between $90 and $100 a barrel on Brent, because at $90, $100 a barrel, they can make money, right? I was in the Middle East the week before this week, and so I got to know a lot more about the fiscal situation there. And like the Saudis' break-even oil price is about $75 on Brent. So they need, when you start getting down to $80, which is where we were getting before they announced those cuts, you're getting pretty close to that, that break even. And that's a problem for them, because when I say break even, they don't have cash to invest in all the investments they're making in trying to diversify their economy. It's just meeting the basic needs of the population. So my view is that as the SPR starts to get to a place where it needs to start winding down, we'll see OPEC respond to that. Obviously, other variables matter, like what the state of the economy, how much oil is China buying, so forth and so on. What's going on with Russian oil, the price caps and everything else. But I am assuming that the OPEC is a rational actor, economic actor, and will price oil at 90 to 100 bucks a barrel. And they have capacity to, given the slack in oil demand and capacity, they have the ability to calibrate things for that oil price. So that is my working assumption here. Yeah.
Okay.
It makes sense. Yeah.
Yeah.
Okay.
Provided there's no recession. Yes.
Okay. All right. So we talked. Yeah. No recession. Inflation is coming in a lot faster, and one of the reasons is global oil demand is going to be evaporating, right? And oil prices are coming down. Yeah, no, totally agree. No, I'm trying to figure out how we get inflation down without actually going into a recession.
Got it.
By the way, retail sales just came out.
Oh yeah, what were they?
Well, I can't quite
Zero.
see the entire, but it's no change over the month. Zero.
What was expectations? Does anyone know?
It was positive. Small positive.
Small positive. Yeah. Right. Okay.
0.2% was consensus.
Okay. I guess the one thing we need to know is X food, energy.
Yeah.
Excuse me, not X food, energy, X cars,
X autos.
Yeah.
0.1% up.
Okay. And gasoline. That would probably have to be positive, probably, right? X auto, X
gas and autos is 0.3%.
Okay. That's not bad. And what about X auto, X gas, X? I know I'm stretching things. Building material, because that's what goes into consumer spending.
Yeah, you're right. You are stretching. It's not in my alerts here.
Okay,
we'd have to go in the report.
You know what they call that? Control. Maybe that's Marisa's statistic. Control retail sales. Yeah. Okay,
that would be a great one if she selected it during the podcast.
Right.
That would be
a good one.
Yeah.
Well, maybe we can try to figure out what that is, the control retail sales, if we have an opportunity. But that doesn't sound great, but it doesn't sound too bad. 0.3 X auto, X gas. That seems pretty reasonable. Okay.
Is that too hot? Is that still too hot then?
I don't know.
Fed's expectations, right?
Well, if there's a little bit of inflation, right, that means like zero real growth, doesn't it? Sort of mean that. I mean, it feels like roughly where you'd want it. I think. All right, let's keep on the frame. So we talked about energy and the pass through into food and other downstream prices, goods prices. The next thing is supply chains and various prices for products that got disrupted, prices that surged because of the disruption to the supply chains. Vehicle prices being the poster child for that, but goods prices more broadly. And we got a 0.8 on new vehicle, another 0.8, I think, right? On new vehicle. Those increases have got to stop, right? I mean, they can't keep going up. And my thinking here is, and used vehicle prices, they're no longer going up, but they didn't really fall, they're not really falling, at least not falling as much as you would think, given the auction prices, right?
Okay, but they fell 1.1%. Right?
They've fallen 3 months in a row.
Okay.
Right.
They should be falling, but I think they should be falling more.
Faster. Yeah, I agree with that. But at least they are
moving in the right direction. Yeah. So my thinking here is we should get good news as well, right? Because again, I'm making assumptions, but the assumption here is that supply chains continue to iron themselves out. The China's back up and running. They've gotten through the last wave. In future waves, probably won't be as disruptive because they'll wind down their no COVID policy. It feels like that's the direction they're headed. And we should get more chips, more everything you need to produce vehicles. And we should get vehicle production. Vehicle production is already normalized in the US. We're back producing cars at the same rate as we were pre-pandemic. Still in Japan and in Germany, which are the other two major, other than China, vehicle producers in the world that export, their production is still well below pre-pandemic, but that should improve with the supply chains. And as we get into next year, next spring, next summer, we should start to see enough vehicle production where inventories start to rebuild and price growth moderates and even starts to decline. So we get vehicle prices at right now adding significantly to inflation. They will start becoming neutral to actually a weight on inflation, let's say, 6-9 months from now. Okay, let me stop right there. What do you think of that perspective? Chris?
Supply chains are improving, right? If you just look at the cost to ship a container across the ocean, across the Pacific, right, it's come way down. So that's one indication. But we do have some labor unrest potentially, right? We have railroad strike potential that the union voted down. So I think really across the globe, across Europe, you have workers who are responding to the wage pressures as well, asking for more, threatening strikes. So those supply chains, I still see as being somewhat fragile there, right? I think your script makes sense if nothing else happens, but
yeah,
there is that risk that things could turn around here.
Yeah.
So I think you're right in terms of the broader trend. I also wonder if consumer demand might moderate for new vehicles as well, right? Even if we don't go into recession, right, people are going to be a little bit more cautious and on edge, and that certainly could help remove some of that inflationary pressure. So,
right.
So I agree with the outlook there, but yeah, there's
the risk,
touch and go in terms of the risks that are out there.
Yeah, Marisa, anything to add there on the supply chain?
Just that I saw that within the vehicle sector, it's not just manufactured new vehicles where prices were up. It's also parts and repair services and all of that, right? So that kind of makes me wonder if there is still some supply chain stuff going on. If there are, we know some of the parts and the metals that are used in cars have to pass through Ukraine, Russia, and with that conflict still going on, there's always that chance that things become still, they stay messy. So until that completely clears, then I think there's always that risk that you have some disruption for some of these commodities coming out of that part of the world. So generally, I agree with you that should be the trajectory, but I think there's still that risk out there.
Yeah. I guess the other thing to add to the pot here on this issue is other goods prices. I picked vehicles as the poster child, but there's been other significant disruptions to the delivery of other goods, from building materials to appliances to consumer electronics to apparel. And it feels like those are becoming less of an issue as well. In fact, we've seen inventories of those things build up pretty significant degree, and it feels like retailers are going to have to be pretty aggressive with their price discounts on those products as we go into the Christmas buying season. So I think that should also be helpful as we move towards the end of the year into next. Yeah. Okay.
Yeah. Smartphone prices were down again. So.
Yeah. Although they're always down, I think, right? Aren't they?
You had this new iPhone come out. Yeah, exactly. It does a lot more, but at the same price. So.
Yeah. I mean, that's the quality adjustment that the BLS, the Bureau of Labor Statistics, does, I think.
Yeah.
Okay. All right. So we got energy, we got the downstream effects, food, and some other products. We've got supply chain, vehicle prices, maybe some goods prices. Let's turn to housing costs and rents. And here too, it feels like we might have some better news, right? I mean, I'm going to turn to you, Chris, because you know the data better than I. But my cursory look at the data here is a bit of a blur, being in Europe and Asia. But it feels like market rents are starting to really weaken. I don't know if they're declining yet.
Oh.
Are they declining?
So asking rents.
Asking rents. So kind of the market rents, not what's in the CPI, because that reflects market rents from 6 months ago or 9 months ago.
Or the entire market, right? So for new leases, yes, they are weakening. Certainly on a month-to-month basis, and year over year is coming down. across many markets. So yeah, that is helpful. That points to some weakening in the overall CPI inflation component. But as you alluded to, right, it takes time for those new market rents or new leases to actually filter through into the CPI inflation index of all leases. So we might be at peak, that's good, and then we'll gradually see some weakening throughout 2023, but it's going to be a long process. I mean, housing is going to continue to push up on inflation for a while here, even after, right? Even if the other components that you mentioned start to turn and go away, just by the nature of how it's calculated, housing is going to continue to be a drag.
Do you know, are rents actually falling yet nationwide, or are we talking about that the rent increases are moderating significantly?
On a month-to-month basis,
sequential basis.
Yes.
They're falling.
Yep.
Oh, cool.
At least well, there are lots of different indices.
Yeah.
Right? The ones I've seen, the major ones, yeah, they do show decreases month to month.
In what's going on? Well, I mean, I'm sure it's supply and demand, but what's driving this right now?
So both
weakening in asking market rents.
I think a lot of it has to do with the affordability piece, that people just can't afford to pay more, right? They're not getting the wage increases that would allow them to pay that extra 10% or 15% that they might have been required to last year, right? And that is leading to household formations slowing or outright demand destruction. You do have supply coming online too, as you mentioned, right? So that's the one bright spot in the construction picture. When we look at housing, it's the multifamily side. Starts have been strong. Completions have been continuing to ramp up. So that's positive. That is putting more supply on the market. But yeah, I think it has more to do with the demand weakening, right? Although there's lots of demographic demand out there, people want to move out. It's just not affordable for them at the moment.
Yeah, so-called demand destruction, right? The price is so high, they literally can't afford the rent. Therefore, the household doesn't form that otherwise would have formed. Yeah.
Yeah.
What about they're not going to be first-time home buyers either, right?
That's for sure.
Right now,
right?
I mean, that's not an option.
At 7% mortgage now.
Yeah.
Well, I think earlier in the year when mortgage rates didn't get as high as they were when they first started to rise and affordability for single family became an issue, that actually helped increase demand for rent.
Yeah.
Right.
Because potential first-time buyers couldn't become first-time home buyers. They stayed renters. That juiced up demand. But now we're at a point where you can't afford a single family home and you can't afford the rent. And that's causing that demand destruction, and that's causing rents to weaken, along with the increase in supply that we're getting. It is, and again, going back to supply chains, as they iron themselves out and building materials become more available, as appliances become more available, you can complete more multifamily units. And there's a record number of multifamily units in the pipeline to go into completion. What about remote work? One dynamic that I think might have served to increase rents is the move of people from big urban centers in the Northeast down to the Southeast and to Texas, and folks from the Pacific Coast into the Mountain West. And that really, it helped moderate rents in the big metropolitan areas, but it really juiced up rents in the places where they moved to. And it feels like that also contributed to the strong rent growth. And that now is starting to unwind, or at least slow down and becoming some issue. Do you think I think we had John Burns on, and that was a point he was making. John Burns being, a really great housing economist. Does that resonate with you guys as well? Marisa?
Yeah.
Or Chris? Go ahead.
Go ahead, Chris.
Yeah, I think so. Right.
At
least at the very least, I don't see more or accelerated remote work arrangements. If anything, people are taking a second look in terms of, or employers are taking a second look in terms of requiring people to come into the office a few days a week, the hybrid work. So we may not see a complete reversal, right, in terms of those remote work arrangements, but I don't think we're going to see much more anytime soon. And so that that should contribute to taking off some of that demand or pressure as well.
Right. Okay, so my kind of forecast expectation is that now that asking rents, market rents are weakening, actually declining, that will start to translate over into weaker CPI for housing costs, rent for shelter, homeowners equivalent rent. Not soon, not quickly, not certainly between now and the end of the year, but by next spring, summer, I would start to expect that to start to slow and become a much less of a tailwind to overall inflation as we move to the second half of next year. Does that resonate? Does that make sense? Yeah. Okay.
Yeah.
You're shaking your head. Okay. Yeah.
It won't be fast, but
It won't be fast. That's a year from now when
exactly.
it starts to really show up. But that goes to my forecast. We go from 8 now to 4 by next spring, summer, and then getting from 4 to 2.5. That's going to be more work, and a part of that is the slowing in housing costs. We're not going to get 0.8. 0.8 is what we got last month. We're going to start getting something much less than that a year from now. Okay. All right. Here's the next thing. Wages, wage growth. This goes to the cost of the consumer prices for all kinds of services. Most significantly, I think medical care, because medical care is a source of inflation that's become much more of an issue in recent months. And I think that goes back to the fact that the healthcare sector is very labor intensive. And if you've got strong wage growth, that starts translating into strong cost of medical care. The hospitals and other facilities started to raise their prices more aggressively. And that takes some time for that to occur because there's all kinds of contracting that occurs that slows down the transmission of the higher labor costs to actual medical care inflation. But it's now starting to show up. But my thinking here is that this is where the Fed comes in. The Fed is raising interest rates and will continue to raise them aggressively, significantly enough to slow down job growth, virtually coming to a standstill, causing unemployment to start, causing all those unfilled positions to evaporate. That's already started, causing layoffs to normalize, causing unemployment to start to edge higher. And that will allow wage growth to roll over and start to move back to something that's more consistent with the Fed's inflation target. That will take a lot of time. And that's why it takes close to 18 months. It's not until, spring, summer of 2024 before inflation is back to target. Marisa, what do you think of the logic of that logic?
This is the part that worries me the most. I mean, we've already seen wage growth kind of seemingly top out, right? If you look at the ECI and you look at other measures of wage growth, it doesn't look like it's accelerating anymore. It's around 5%, and it's kind of hanging there. So the non-acceleration is good. What worries me, you mentioned medical services, right? But it's kind of a lot of services. If you look at that CPI report, it's all over the place. And that's where I get worried that, are we entering this situation where all types of businesses are starting to raise prices based on labor costs? And we're going to get into this cycle of then workers asking for more money and businesses relenting and then raising prices again. We've talked about the wage price spiral on this podcast before. Job growth has to slow, right? I mean, I think in your whole arc of everything you're saying in the back of, I know you're saying, I'm assuming no recession, but in my mind, I feel like we need some demand destruction to get from 8% to 3% in a year.
18 months.
Yeah. Okay. from 8 to 4. 2 years.
Not to put a fine point on it, but okay.
To go from 8 to 4, 4 to 2.5, or the plan.
Okay, let me push back on that a little bit, and then we'll get Chris into that, because I'm sure Chris.
I'm just sitting back and enjoying.
Yeah. Let someone else do the heavy lifting. Carry the water. Okay, so it feels like wage growth is about 5%, and in fact, as you pointed out, more recent data, and I don't want to put too much weight on it, feels like it's less than that, 4.5 to 5. If you look at the average hourly earnings numbers, I know we don't like to do that, but okay. I look at it when it conforms with my priors, and I'm honest about it. At least I'm honest about it.
Yeah.
There you go. It's on record, folks.
Okay, it's on the record. And we, in my view, need to get to 3.5% to be consistent with the 2% inflation target. That is 2% inflation plus 1.5% productivity. That's 3.5%. So if you get wage growth, that's 3.5%. That's consistent with productivity. And of course, there's all kinds of rounding here, but that's non-inflationary if we get there. So we got to go from 5-ish, maybe a little lower, to 3.5. You don't think we can do that if the job market comes to a standstill? If job growth comes to roughly a standstill, it's hard to calibrate that exactly, and you have unfilled positions evaporating, layoffs normalizing, unemployment notching higher, slowly, but over time. You don't think that's maybe what you're saying is, Mark, that sounds good on paper, but how can you?
Okay, but that's not a recession.
That's not a recession.
Not a recession. It's just no job growth. Unemployment rate goes higher. Yeah. I think we could. There's another side of wage measures, and that's compensation. The non-wage compensation part of it. We know medical costs are rising. I think even in the CPI report, they showed insurance costs, like medical insurance costs. So there's all these non-wage benefits too that employers have to pay. They can adjust wages, but they're basically kind of price takers in a lot of situations when it comes to the non-wage benefits. So yeah, I guess the calculation can work if wage growth, or excuse me, if employment growth comes to a halt for a period of time.
Okay. All right. Well, Chris, I can hear what you're going to say, but go ahead and say it. I can repeat it, but go ahead. Go ahead. I know.
No.
Go ahead.
I think there is that path more broadly, but I think we also face deeper structural issues that, especially in medical care, right? Aging population, immigration policies that limit the number of healthcare workers. So I'm really struggling to see how that sector in particular, medical care, actually sees limited wage growth. That can we really eliminate those job openings?
Labor
really
shortage in that sector too.
Already labor shortage. Are we really going to pull back even more? And this, I also think, goes to the demographic differences in the across households at this point in terms of the financial positions, right? So you have some older, more wealthier households, right, continuing to demand healthcare, right? And they have financial resources. They have a lot of excess savings at this point. Very hard for the Fed to do much to curb their demand for those inelastic goods. So I think they're fighting a real uphill battle in some of those sectors. At the same time, you have the lower income households that don't have those resources, who are fully exposed to those inflationary pressures. Yeah, they'll cut back on their spending, but they are not the bulk of the overall macro spending. So that's where I see really a complicated environment here when it comes to Fed policy and truly getting the demand down sufficiently to curb inflation without causing a recession. That's the crux where I'm really struggling because of these structural issues.
Yeah, I guess the one area where I feel most vulnerable in terms of my forecast is medical care inflation. And adding to that is the fact that has medical care inflation that has a much higher weight in the consumer expenditure deflator. There's two measures of inflation that we look at. One is the consumer price inflation. That's what we've been talking about. But the reality is the Fed targets the consumer expenditure deflator. and it's weighted differently because it's just measuring inflation in a somewhat different way. And medical care has a much lower weight in the consumer price index, much higher weight in the consumer expenditure inflator. And that is flip on housing. Housing is much more important to CPI. And one reason why CPI is so juiced is because it has a very high weight on housing. The PCE, the consumer expenditure inflator, a lot less. But if medical care inflation continues to accelerate, that's going to be more of an issue for the PCE than the CPI, and complicates the Fed's ability to, normalize policy, and to avoid a recession. So I hear you. We've already, this has gone on quite a bit longer than I expected. Yeah, always does. I always enjoy these conversations. Let's go to the game. Let's go to the statistics game. And of course, we each put forward a statistic. The rest of us, the other two of us, are going to try to figure that out through questions and deductive reasoning and clues. And the best statistic is one where it's not too easy, one that's not too hard, and is apropos to the topic at hand, which is obviously inflation, but it doesn't have to be. It could be, you have a license. So let's go with you, Marisa, first. What's your statistic?
Okay, my statistic is 31% in September.
Is it in the consumer price? Is it related to the consumer price report? Ooh.
Oh, wow.
Okay. Is it in the
It's
NFIB?
It's not in the no, it's not in the CPI report, but it is related to inflation.
Oh, okay.
Is it a derived statistic, something you calculated?
No.
Is
Mark,
it in
you said it.
NFIB survey?
It is, yeah.
The percent of businesses that are raising prices? Or
the other thing.
Prices.
Yeah.
Raising price. They said they're going to raise prices.
That are planning on raising. So it's the net percentage. It's a diffusion index. The net percentage of small businesses that say that they will raise prices in the next 3 months.
I didn't realize. Wait, that's not a.
It's the percent who say they're going to minus the percent who say that they're going to hold prices steady or lower prices. It is, yeah.
Okay.
And that is down from an all-time series high, and this data goes back to 1986. That was 51% in November of 2021. So in November 2021, it reached this all-time high. It kind of stayed up there, and it's been falling since. So now it's down to 31%. And this series is pretty tethered to overall CPI. If you plot it along with the growth rate of CPI, they track very, very closely. And it leads a little bit too. So this may hopefully go to the argument that inflation will abate one of these months, that we'll start to see.
Wait.
Yeah.
Wasn't that my argument?
I'm sorry?
That was my argument. Right?
I know.
She's arguing for you. She's giving you a fighting chance.
I know that was your argument. Okay. Yeah. So I'm
saying
saying here's some supporting evidence for that argument.
Fine. Okay. Yeah. Very good. Cris, do you hear that? You see how this is done? You come up with data that supports my argument.
That was not my. That wasn't my intent at the outset.
No, I know, but I'll definitely take it. I'll definitely take it. Yeah. Okay. I get some credit for that. Don't you think, Cris? I thought.
Yeah, I don't have my cowbell, but.
Yeah. Okay. I thought that was pretty good.
Save it for next time.
Okay. You're up, Cris. What's your statistic?
28.2%.
It's in the CPI report.
It's in the CPI, and you alluded to it earlier.
Oh, it's airline tickets?
No. Those I think were like 40 plus percent, 42%.
This is year over year. This is a component that's up 28%.
28.2%.
A good or service that's up 28%. Is it in food? Not food.
No.
That's 10%.
It's a service.
It is a service.
Sorry, you said it was month over month or year over year?
Year over year, thank God.
Gotta be year over year.
Well, there is some crazy stuff going on even in the, yeah.
Wow.
This one's pretty crazy as well, 28.2 in a year. So that's why I
you're saying,
highlighted.
I know what it is. Auto repair?
No,
No.
that was up a lot too.
That was up a lot. Yeah. Um,
I alluded to it.
Yeah.
yeah. What component is up 28% year over year? And it's a service. It's
It
not
is.
it's a service. Okay.
Yeah.
It's not healthcare related.
It is healthcare related.
Oh, it is. Oh,
Yeah.
what would that be, Marissa?
What did I allude to?
yeah,
Oh, I said there's a short, is it nursing homes or
No,
nursing
Wow.
facilities?
no, it's simpler than that. It's not as detailed, I guess.
Oh, I give up.
Okay, health insurance as measured by the CPI.
Oh, okay.
Health insurance.
Up 28.2%, up 2% in the month,
I
right? So
did allude to it, but I didn't know what the number was. I just knew it was really big.
it's huge, right? 28.2. Now the CPI has a weird way or different way to calculate health insurance, right? Than the PCE, right? It's CPI is just capturing consumer out of pocket.
Mm.
Yeah. So that would be, what would that be? Like private health insurance? Like I'm trying to figure out who that would be, who would pay that.
My guess, my understanding, and I tried to dig a little bit, it's really dense, right? They go into this retained earnings calculation. It's quite complex how they try to derive it. I believe it though, it is an individual who's going out and purchasing health insurance on their own. What is the increase in the premium that they're
and they don't
facing.
go on Obamacare or something like that. They can't get Obamacare.
I guess so. That's my
that's interesting.
My sense.
Yeah. Okay.
Whether it's right or it does
makes the point.
Factor into the inflation, right? So you want to always be careful. It's not a huge component, but to the extent there are some measurement issues here,
right,
they could influence the inflation as well.
Okay, I've got one for that. Not bad. That's okay. That was a little esoteric, but interesting.
Just well, Marissa took my first one. So.
Yeah. Oh, yeah, that's true.
Services.
Yeah. I got one, and I'm not sure. This is going to be a hard one. I'm sorry to say, but also I might have to give you a hint. It is related to the discussion we were having around inflation and the framework I put together. And but I'll give you the statistic. It's 439 million. 439 million. Any
number that came out this week.
Indeed it did. Yeah.
Oh, no. 439 million.
Yeah. Big number.
Units or dollars or?
It's not dollars.
It's not dollars.
It's
it can't be housing.
Not
related.
housing related. No.
It is energy.
Energy related, yes.
Oh, is it inventories?
It is indeed. Oil inventory.
Oil inventories.
Oil inventories. 439 million, up a lot, almost 10 million barrels in the last week. We get this data from the Energy Information Administration every week. And I watch it pretty carefully because obviously, we need oil. And it's probably overstating the case. I'm wondering if Hurricane Ian might have disrupted exports because exports were down quite a bit, during the week. It may also be, there's a lot of discussion. Maybe we should restrict exports. The Biden administration, at least some rumors coming out that they've been thinking about that. So maybe there was some holding back of exports. I'm not sure. And that if you don't export, then that stays in inventory and causes the inventories to jump. But it does highlight something very interesting, and that is demand for oil is way down. It's almost 4% lower today than a year ago. So there is a lot of demand destruction going on as a result of the higher energy prices. And, that helps with inventory, which ultimately helps with price. And I think it's one reason why oil prices, did not have come back in despite OPEC OPEC's announced a production cut. So we need to watch that very carefully, and certainly that number moving it in the right direction. So, and I will say consistent with my forecast, my forecast of where things are going. Okay, let's end the conversation this way, because Chris, I know you need to go. Two things. One, I want you to lay out what you think the path for the federal funds rate target is going to be in your most likely scenario for the economy, and also what is your probability of recession? Maybe you should begin with the probability of recession. What is the probability of recession over the next 12 to 18 months? And then what does that mean for the federal funds rate target going forward? And I don't know, Chris, do you know, last I looked, the market's expectation was for the Fed was that the Fed would raise the funds rates 3/4 of a point when they meet in November, 1/2 point when they meet in December, another 1/4 point when they meet late January next year. That would put the federal funds rate target at 4.5 and 4.75%. And that's roughly the so-called terminal rate, the high point for the funds rate. It stays there for most of 23 into 24 and then starts to come in. Is that, do you know, Chris, is that roughly right? Can you tell?
I looked yesterday and it was after the CPI report.
Oh, it was after the CPI?
Yeah.
That was roughly right? Okay.
Yeah, it looks like terminal rate of 475 to 500.
Mm-hmm.
It's 470 to 5.
Yeah, so it's
that's a little higher.
That's an extra 25.
That's another extra 25. There.
And there's more probability now on
75. The next,
500 to 525 or 550.
Yeah, right.
Right.
Okay.
So it definitely moved up.
Okay, so let me say what I just articulated is my forecast for the funds rate, and I would put the odds of recession over the next 12 to 18 months at 55%. They did go up. I was at 50 last week with the CPI number. I think the path forward is now more difficult, so I put them at over even odds over the next 12 to 18 months. What about you, Marissa? What's your view?
I was thinking between 60 and 2/3 probability of recession. Yeah,
Okay.
over the next year.
Right.
Is
And
that
above
invert?
2/3?
Let's put it right at 2/3.
Okay.
you want to go right up to 2/3?
Yeah.
Okay. And of course, for the listener, that's a key threshold, because once we go over 2/3, then you're arguing for a change in our baseline.
In the forecast, yeah. Yeah.
So you're not calling for a recession yet in our baseline.
It's becoming harder for me to say that I'm right on that verge.
Okay.
I'm right on the edge.
Fair
Yeah,
enough.
where it's becoming harder to say that there won't be a recession.
But you're still saying no recession in the baseline.
Yeah, because you are. It's your forecast.
No.
That's what I have to say to people.
No.
I'm not making my own forecast.
We're all going down together. No. Okay, and what about the funds rate forecast? And you don't need to have a view if you have a view. Different.
Yeah, I mean, I keep waiting for the inflation, the CPI report to turn over, right? And it's not. It's looking more persistent. So I think the path you laid out for another 150 basis points seems reasonable. But if we get another report like this, I think then then I'd be more in line with what the market's saying of an even higher terminal rate.
Yeah. Okay. What about you, Chris?
I'm sticking with the 70% probability of recession. And probably 425 to 450 on the Fed funds.
We don't get there because we go into recession sometime early next year.
Right.
You think early next year, like next spring-ish.
Spring-ish. The timing's hard to pin down exactly, but yeah, I think it's first half of the year.
I think anyone who says we should have a recession has to tell us when, right? That's only fair. That's fair.
It's fair.
It's fair, right? Okay. And next month, I'm going to ask you what month we're going into recession, because you got to put it into the forecast. You got to put it into the forecast.
Oh, okay. I thought it was going to be the day and the hour, but month is no problem.
That's coming. That's coming. Refine your models. Yeah. Okay. All right. Very good. Anything else folks want to bring up, you guys? I think we covered a lot of ground. No?
Have a safe trip.
Yeah, thanks. I'm looking forward to coming home. I'll be on a jet flying back tomorrow. Get back in New York late tomorrow. I'm really looking forward to it. How's the weather there?
It's a little cloudy, rainy,
Oh, geez, bummer.
but the Wawa coffees will be waiting for you.
Okay, I'm looking forward to the Wawa.
There you go.
That's the worst thing when you leave your coffee behind. It's like terrible. Your day is never exactly right without the right coffee. These cappuccinos I'm drinking, Anyway, all right, we're gonna call it a podcast. Talk to everyone next week. Take care now.